I've come to learn that whether you consider yourself an investor, a trader, or something in between, there are underlying principles of decision making that separate successful from unsuccessful people. So, on today's episode, I'm sitting down with someone who isn't a trader, but a strict value investor. His name is Ben Claremon, and he's the principal and portfolio manager at Cove Street Capital, responsible for about $700 million in assets allocated into a variety of different long only strategies. Now, Ben and I look for different opportunities in the market, but I was amazed by how much I was able to learn from hearing out his underlying principles and philosophies for trading. It really actually gave me a ton of ideas for my own trading. And beyond that, it was great to see how many similarities there were when it came to some core decision-making processes, such as the way we differentiate between luck and skill and track whether we're on the right path or not, the importance of doing qualitative research on top of just what the hard numbers show us, and a number of other topics that I can tell are really going to help my bottom line as a trader. So my name is Sean Ryan. I'm co-founder of Predicting Alpha and host of the Predicting Alpha podcast. And this conversation is so juicy that we're just going to go ahead and jump right into it.
Sean, first off, thanks a lot for having me on. So I am Ben Claremon. I am a principal and portfolio manager at Cove Street Capital. Cove Street is a $700 million long-only investment firm located in Los Angeles. I co-manage our SMID cap strategy, which encompasses companies from the kind of call it $1 to $12 billion market cap range. I just celebrated my 10th anniversary here. I joined Cove Street right out of business school. So it's been an interesting last decade here. Originally, I was in commercial real estate. My family is in that business. And so I went to UPenn for undergrad. And after graduating, it was the obvious path for me to join the family business, which I did. Call it 4 to 5 years in, I started to lose some of the love for what I was doing. And that period of my life coincided with a friend of mine handing me a copy of Ben Graham's book, The Intelligent Investor. It's a little bit of a cliche because so many value investors started by either reading Buffett or Graham, but it is what it is. It is my story. I read that book and I said, this speaks to me. There's something about the markets that really attract me. I think I was a value investor before I knew what a value investor was. It was in my bones. It was in my DNA. And so I made the decision to leave the family business, and I was really fortunate to get my job on the buy side. Fortunate to get a job, unfortunate timing when the firm I work for started up in September 2007, which was kind of the beginning of a very volatile period in financial markets. And, it was a trial by fire in a lot of ways, and I learned a lot through that period. But as the financial crisis was winding down, thankfully, I was looking for my next steps. And that's how I ended up at UCLA for business school. And then subsequently in LA, how I ended up at Cove Street.
Yeah. So a question that I love to ask people is when you first started looking at financial markets, some people start at such a young age, but it sounds to me like you actually got started, a little bit later than most. Like your first passion was real estate. Is that the case, or were you already into investing prior to reading The Intelligent Investor?
I mean, I think I had a sense of markets and a fascination with it, but it wasn't like I was reading 10Ks and Buffett's letters when I was 18 years old. I mean, I know plenty of people who started their value investing careers very, very young. And so that wasn't me per se. I really enjoyed real estate. I still love real estate as an asset class. It was the day-to-day management of it that I wasn't too thrilled with. So, it's not like, I picked up value investing in my 50s. I was in my mid 20s, but I didn't really have a desire necessarily to change careers. I mean, I think I probably would have stayed in real estate even if I'd left my family business until I learned about value investing and decided that this could be a career path for me. And, I think, as I think back on it, what really spoke to me about the investing part was finding underappreciated assets. And you can do that in real estate too, but there was something about doing it in financial markets that was really interesting. to me, and the challenge of beating a very competitive market was kind of thrilling. And it becomes less and less thrilling as you do it for longer, because you recognize how hard it is. But the other thing about value investing, which is just so unique, is that it's such an inclusive community of really, really nice people and super bright people. So I've been inoculated into this value investing community, and I've made lifelong friends through it. And I've just found like such high quality, high IQ, very nice people who, all are part of this, Buffett Graham cult. And so I think like that makes what I do less of a job. And I think, my wife is always just like, can't understand that, like, I love doing this. This is fun for me. I would do this even if I wasn't paid to do it. And there just aren't many other careers that are like that. I mean, yes, if you're a professional athlete and you can play sports, like, yeah, that sounds like fun. I mean, I'm sure it's really stressful as well in a lot of ways, but like, you might love to play basketball or something like that. I just, you know, I think there's something about investing that is, permeates your life, and it's not just a job. It really encompasses a philosophy, and in some ways, like, you're always thinking as an investor.
I think that's beautiful. And you said something at the start that I think is great, which is that uh, it's such a competitive space. And for me, that's actually one of the things that keeps me always, thinking about the game and excited to learn more and look for a new edge, etc., which is that it's a competitive space. And one of my previous interviews was with someone from Jane Street, and they had said one of the things they liked about it was that trading is such a pure profession where the work that you put in, you actually get paid for. It's not like you're necessarily going into, um, you know, uh, sell a product, and even if it's a bad product, you can still make money. It's like you get paid for doing good work and being, in a sense, like better than the next guy, right? Like making better decisions over the long haul. Would you say that's one of the reasons why you find it so intriguing?
Intriguing and frustrating at the same time, in the sense that, um, there's no clock that goes off or a bell that rings that says that you've done enough work on a company to be able to generate some kind of analytical edge. It's also frustrating because you can do an enormous amount of work, and then something happens that is completely outside of, like
Yeah.
COVID, for example, outside of what your consideration set was, and you can lose money, even if your work was solid, even if your decision making process was you know intellectually honest. And so it is both challenging and thrilling and fun all at the same time, which I think is why it's so compelling.
I want to ask you about that quickly because a lot of traders struggle with that. And when you're looking at an individual trade, that can be extremely frustrating, where you do a ton of work, a ton of due diligence, and then something happens and the trade goes sideways or the investment goes sideways. But that doesn't necessarily make it a bad investment, right? And that can be a very frustrating thing to deal with, especially if it happens like early on. For example, you getting into the space in 2007, I'm sure 2008 was, you're sitting there going, what am I doing? Like, what's going on here? Where did I go wrong? Do you have any advice for someone trying to reconcile that? Or like, how can someone look back and evaluate that decision in the context of some sort of outlier event? You know what I mean?
Yeah. And so I think the first thing to do is focus on process and not outcome. Right? Outcomes are things you can't control. Processes you can control. And so if you think of life on any endeavor with a four square box, where on the top you have, on the top you have, like, uh, well, let me just put it this way. So a good process and a good outcome, that's what we call like skill, right? A good process and good outcome, right? um, but there's other boxes, right? If process and outcome are on the top and on the side, you can have good process and bad outcome. That's what's called bad luck,
Yeah.
right? And so you can have done everything right, and then something happens off your spreadsheet, and you lose money. You know that sucks. But if your process was good, right? And your decision making was sound, and you wrote down your decisions, and you can go back and look at them and say, well, what was I thinking at that time? Does it, was it intellectually honest? Was I hugely biased or not? Is my work supported by the evidence that I saw? And look, there's always Monday morning quarterbacking. You can always go back and be like, I wish I hadn't done this, but you're always making decisions under uncertainty.
Mhm.
So there's always going to be things you don't know the answer to, right? And if you make a decision that is well researched and well thought out, and you're wrong, well, that sucks. And that's markets, right? That's why no one bats 1,000. That's why, you just, to stay in this game, you just have to be probably better than 50 or 60% of the time, to making money, and you'll probably be able to be, pretty, it'll be pretty remunerative, and it'll probably be a good career. But I have to focus on one of those other boxes that I haven't mentioned yet, which is, bad process, good outcome. And so I think in a lot of ways people get fooled, by what randomness or noise, right? Where you have a bad process, where maybe you're entering an investment without doing a lot of work. You are ignoring valuation. You are not doing enough diligence on the people who are involved. And whatever, the stock gets bought out 3 weeks later, and you make 50%, and you think you're smart. That's good luck, right? And that's the opposite. That's on the opposite side of, good process, bad outcome. And so, was that luck? Was that skill? And so I think you just have to distinguish that. And then the last box is bad process and bad outcome, which I think are probably highly correlated. For the
Yeah.
most part, if you have a bad process, you're going to have a bad outcome. So if you think about investing in those 4 quadrants, you can start to have a sense of how to handle outcomes that you're either happy with or unhappy with. And as long as you're intellectually honest about your process and what you were thinking, and you record those decisions, you have the ability to learn from both successes and failures.
I think that's an amazing sort of framework to think in, those different boxes. Something that I usually say to traders and investors is, not every good trade is profitable, and not every bad trade is unprofitable, right? Sometimes you can have a bad trade that wins, but
Yeah.
doesn't make it a good decision.
Yeah.
And so I totally think methodology over outcome is a huge thing for traders to focus on. But you mentioned something before about you're continuously making decisions, which I wanted to dig in a little bit more, because it kind of is like that. If you're holding a position, you are still stating your original thesis as you move forward, right? You're saying like, I think this is undervalued. And if you're holding it today, you're sort of still saying it's undervalued, or I see this growth potential for it. How can someone, what's your process for adding new information coming in from the market on a daily or weekly basis, as things change, to your original thesis? I feel like that's something people really struggle with in the investing space, is maybe marrying the initial idea and having a tough time evolving that view as new information comes into the market. What's your experience with that been over the last decade or so?
Yeah, I mean, there's a lot I can say about that. I mean, I'll make two
Cool.
points to start off. So if anyone's read the Phil Tetlock book, Super Forecasters, what you'll see is that the best forecasters in the world start with an initial position, and then they take in more and more and more information, and they adjust their position over time. And so I think of investing as very similar to that, right? Like, what you are doing is you create a premise based on well-researched work, and then you are continually looking for disconfirming information, right? And incorporating that can be very difficult, because something called confirmation bias comes in,
Mm-hmm.
where a you everything you see somehow bolsters your thesis, and things that don't bolster your thesis, whatever, mentally you discard, right? So it can get very, it can get very difficult. And there's other biases, such as anchoring, start to come in, where this is what you thought, and this is what you thought margins were going to be, and this is what this is where the stock was, and that's like your frame, and you're not, and as things change, you're not being dynamic. So the way that we and I tackle that is, again, getting back to recording what you were thinking in real time in a medium that allows you to go back and look at what you were thinking and your decisions. So I think one of the most unique aspects of Cove Street's process is at the end of our investment process, everyone who worked on the idea, and we team tackle our stocks, so we have multiple people working on an idea, everyone weighs in on what they were thinking at that time. We record it in an Excel spreadsheet, which is dynamic in the sense that, like, you have a column for August 2021, and then you'll have a
Mhm.
column for September 2023, and then you'll have a column for January 2025. And you, in January, well, let's call it February 2025, you come back to this time period of time and see what you were thinking. And so it's really hard because, so I always make this analogy, and I really think it works. Is like, think of investing as you're painting a painting. And so you start, you've never heard of a company, it comes across your desk, it's a blank canvas, right? Obviously, you may have some sense of business models and the industry, but for the most part, so maybe there's some scattered dots on there just based on your history. But what you're doing as you get new points of information is you're putting a dot on that canvas, right? And the hope is that as you gain enough information, you can then step back and you can see the bigger picture, right? And so that's the goal of investing, and you're hoping that you can see that picture without blinders, right? You can see it without being hugely biased. And what we know from psychology is that that's not possible to do all in your head,
Mhm.
and that's why you need to have processes and systems to mitigate those behavioral biases. And I think, as I said, the one that I would recommend anybody, whether you're a trader, you're an investor, doesn't, whether you're trying to win, a trade over the next month, or if you're trying to own something for 10 years, write down what you were thinking. Talk about what you think your contrarian position is, and then have that in your pocket to go back to, whether you were successful or unsuccessful. Go back, look at what you're thinking, look at your decisions, and then try to determine, was it, again, going back to those boxes, was it good process, good outcome? Was it bad process, good outcome? Which box does that fit in? And then you can learn whatever your process is, you can learn and help your process evolve so that you can get better for the next investment.
Well, I think process is something we're going to come back to towards the end of this podcast. But I wanted to get back a little bit to your actual investment philosophy. So firstly, you mentioned that you focus on, small, medium cap companies. Do you look at US equities only? Do you look internationally for companies? What's sort of the scope of companies that fall into your consideration?
Yeah. So Cove Street overall, I would call us like mid, small, micro. So anything from 50 million market cap to 12 billion is really our scope. And I've really started to focus on the slightly larger end of that spectrum. So a billion at the low end and 12 billion at the high end. And so our mandate is to focus on the U.S. But that means we can own, if a company has an ADR, we can own it. But we're not like buying Mexican stock, local Mexican stocks, or we're not buying local British stocks. Like, everything needs to trade in the U.S. either through an ADR or on the pink sheets, or whatever it is. We need to be able to buy it. So, I would say my focus is on the U.S. market, but it may be surprising to some people who don't look at the SMID world, but there are a lot of SMID cap companies that are very, very global, right? Like, we're not investing in whatever small companies that just have a California exposure. I mean, like,
Yeah.
we have companies that are 2/3 or more outside the U.S. So I think you can get a pretty global perspective from the companies that we look at. And my bias is diversification, right? Like, not being only in one market means that you have obviously, if that market's doing really well, that's a good thing, but you always have the downside risk of not having other end markets to be able to rely on. And so I'm hugely biased towards companies, whether they're domiciled in the US or elsewhere, having exposure to other countries.
So would you say, like, a part of your investment philosophy is almost having synthetic global exposure through looking for companies that are traded in the US, but have that global exposure?
I mean, I'll state it this way. I'm looking for companies that have the ability to grow through whatever end markets that is. And so I think it's really hard to make money when companies aren't growing. So growth is important, but also diversification so that they can take a punch. And so this take a punch concept has become really important to me. So what does that mean? What it really means is that you want to invest in a company whereby if a single end market or a single customer or a single geography goes south for some whatever reason, it's not an existential threat to the company. It's just an annoyance. Maybe the stock goes down, but you're not really seeing permanent capital impairment. And so that's so part of that diversification that I look for is having international markets that are growing, that are higher margin, that are whatever you want to think about. I want to be not just tied to one end market or to one customer. And so that's like a broader theme for me because I I believe that there are only two rules in investing. First rule is don't lose money, and the second rule is don't forget the first one.
Yeah.
And a really good way to lose money is to buy a company that has one thing going for it, like a single product pharmaceutical company or a an apparel retailer that has a 25% customer that could walk away anytime, right? And if that did happen, who knows what's going to happen in the company. So if you're trying not to lose money, my advice to anybody is to, whether it's geographic or just based on customer diversification, you want companies that are able to take a punch.
When you're looking at the small cap space, there's probably a lot of companies that sort of fit that one punch knockout risk. So do you avoid these companies, or are there other strategies in place to sort of mitigate this TKO risk?
It's something I've thought a lot about as my career's progressed and I've evolved as an investor. And so maybe it's important to take a step back here and talk about my evolution as an investor. So I started as
Let's
a
do it.
Ben Graham investor, as I said, right? Like I read The Intelligent Investor, and Ben Graham was a balance sheet oriented investor. He was looking for statistically cheap stocks from a balance sheet basis, things that were trading at less than their working capital, right? And
Mhm.
so that those things don't really exist anymore, but the ethos of that is cheap. Cheap is good, right? Quality of business not as important, the people are not as important. Really, like the deep value ethos is look for things that are cheap. And I think I've learned through the hard way that it's a very difficult way to make money consistently. And let me say why I've learned that is so in if you're buying something because it's cheap and it's a lower quality business with lower quality management that just trades at a huge discount to intrinsic value, and what you're doing is betting on mean reversion, you need to be right twice. You need to buy it right and you need to sell it right, because time is not your friend. And so even if you are right on the purchase and it goes up, you need to be really quick to sell it because it's just going to mean revert the other way. And then on the
Interesting.
flip side, if you buy it and you are wrong, you are not excited to buy it on the way down because it's not a business that's getting more valuable every day. So I want to buy a business that's so good that if it goes down, I think it's a bargain. I think this is great. The market is giving me something, a business I really like at an even cheaper valuation. So, all of that um,
Yeah.
is to say that um, as sorry, what was the original question?
Yeah, no, original question. How do you
Yeah,
mitigate this TKO risk? Do you avoid the
mitigate. Okay,
companies, or
got
do you
it.
have other
Yeah,
strategies in
sorry,
place?
sorry, 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 sorry. I've done a lot of interviews and podcasts in the
No,
last few.
no problem.
Okay. So so the way, getting to your original question, sorry for that little digression, but getting to the original question of how do you mitigate that TKO risk? I think personally, not to denigrate microcap land, but personally, I have moved towards larger companies Larger companies, by definition, have more. I think they have more sophisticated management teams. They have more diverse revenue bases, and they can take punches. And I think if you're buying a business that's getting more valuable every day, which is like another evolution of my career, is like, yeah, if you're not buying cheap, if you're not buying 50-cent dollars, what are you buying? You're buying 90-cent dollars that are getting more valuable every day. So you're paying a modest discount to intrinsic value in order to take advantage of compounding. And so here's the real question I think I have, and I have come to a
Mhm.
conclusion about this, but I don't know that, but other people may have a different perception, is that here it is. Is a cheap valuation enough to protect you from that TKO risk? So in a sense, like if you can buy it at 30 cents on the dollar, but yes, there's this potential for it to go to zero, is that large margin of safety enough to entice you to get involved? And what I have learned, again, the hard way, is that I don't think that's the case. I don't. If there's that kind of binary risk, I don't think there's any, like, for a conservative value investor who's focused on not losing money. It's just not. It's just not in. It should not be on your plate. And so the reason for that is, um, you people get enthralled with upside, right? It's trading at 30 cents on the dollar. It's got, if it goes well, it's probably a 3x. But yes, there's a
Mhm.
zero on the other side. I don't have any interest in zeros, because you know what zeros do? Zeros eliminate your ability to stay in the game as an investor.
Nice.
And so just I don't think valuation protects you. I think you should, my own personal opinion, invest in better businesses that are getting more valuable every day. And if you are investing in something that has either secular problems or binary risk, make sure that you have a very large margin of safety and that there's some kind of catalyst involved, so that you're just not bleeding for a number of years, right? Like, make sure that there's some other way for you to catalyze and find value.
So what I'm hearing you saying is you're looking for companies that have this growth potential, but they are ultra high quality companies.
I
So
mean, quality being a very difficult thing to determine, and I think quality is
yes,
in the eye of the beholder. But as a general philosophy, pay a fair price for a business that's getting more valuable every day, that's run by people who understand capital allocation, and just take advantage of, from a tax perspective and from a, an investment perspective, of the ability of these companies to compound.
I love it. I wanted to ask you, I think that's a really good lens to view the world through. But as you said, it can be kind of tricky, to really define quality. So do you take more of a factor-based approach to that, or how do you actually go about evaluating that? And if you could share some ideas that people can, maybe get people thinking about how to evaluate these companies, that would be great. And one that I'd love to hear you expand on, because I'm sure this is in it, is the people, because I've heard you mention that a couple of times now. Um, so I would love to hear your thoughts on different factors that people could be considering when trying to evaluate the quality of a company.
Yeah, I mean, if you look at, factor analysis, quality is a factor, and everyone has a different perspective on what that is. Like, BlackRock has some quality index, and you can look at what they think that is. Like, I mean, again, like, we're not quantitative investors, so what I'm doing is looking from a bottom up basis. Is this a business getting more valuable every day, which is something that we would call a Buffett stock, or is this a mediocre business that is trading at a large discount to perceived intrinsic value? That's what we call the Graham stock. And so, as I mentioned, I've started to focus more on those Buffett stocks. So
Mhm.
the question is, how do you determine quality? Right? And part of that, to me, I mean, there are two parts to that, and one is people, and one is the business. And so we have three pillars at Cove Street: business, value, and people. So every one of our investment is viewed through that lens. So let's put valuation aside for a second, because
Okay.
that's outside of the quality aspect. So let's start with the business. How do you determine if a business is high quality? So I mean, I think you can determine return on capital in 17 different ways, but and we do on our spreadsheet, because there are so many different ways to calculate it, and for some companies, certain metrics don't make any sense, and so
Mhm.
you have to look at returns in different ways. So let's start there. Like that's where, like if I'm opening up a spreadsheet for the first time, we put in the ticker to our Capital IQ populated spreadsheet, and it spits out numbers of historicals. And I go back and look at returns. Historically, has this been a business that earned a return on invested capital higher than its weighted average cost of capital? That is the baseline, right? And then you got to dig into the business nuances, right? And look, the funny thing, and this is something I've become even more aware of, is like if you're only a people business and you don't have any capital assets, of course you're going to have a high return on invested capital. Good for you. What if all your people walk out, right? Like that's the issue. People businesses that, yeah, whatever, you're a consultant and you're doing really well, and then Accenture takes your entire team, and then yeah, you had a great ROIC, but but there goes your business. And so these numbers, you can't just have a formulaic definition of a good company. There needs to be both a qualitative and a quantitative aspect. But so let's say you start with the quantitative aspect, which is some kind of return metric.
Yeah.
And historical, right? So not like going back historical, and then going forward, is there a fundamental reason why this business would continue to have incremental returns on invested capital that are high? And so that gets into the business nuances. And so you're doing force by forces analysis. You're looking at competitors deeply. You're looking at end markets. Are they growing or shrinking? And so this is where the qualitative side, and this is where the majority of our due diligence really is like determining, is this a Buffett or is this a Graham? And getting back to the painting analogy, you're just putting those dots on the painting and trying to figure out, when you take a step back, do you see a picture of Buffett or do you see a picture of Graham? And so that's where the deep due diligence is. That's where you talk to experts, right? I love expert networks personally. I think you can learn an enormous amount about companies by talking to people who are in the industry, either competitors or former employees. I think that's a great way to learn about a business, but that's where you're reading trade magazines, you're going to trade shows, you're really just trying to understand the Buffett and Graham dynamic. And so that's a long process. Again, there is no bell that goes off when you are there, right? But you start to, as an investor who has pattern recognition after doing this for as long as I've had, you start to get a sense of whether this is, a true Buffett or true Graham. But then you can't stop there. And because a good business run by people who are either unsophisticated or, even, fraudulent or just mediocre can be destroyed. So you have to do the diligence on the people as well. And so we have a deep process for analyzing people. I have a checklist that I go through for every company that is really long. I also teach a class every year to UCLA undergrads about assessing management. And the takeaway from that class is I put up a slide of the picture of an ostrich, and the ostrich has its head buried in the sand. And I say, don't be this ostrich. Just because assessing management is hard, just because you'll never really know 100% whether they're friend or foe, doesn't mean you shouldn't do the work. You have to do the work. And so what we do is we develop a premise: management, friend or foe, right? And just like we talked about originally, you take new information as it comes in, and the scale changes and your perceptions change over time based on what you see, how they talk, capital allocation, those kind of things. And so those two things, as I go back and taking the step back, and the business and the management both bubble up in my mind to the quality factor. And what you really want is a business that can earn a return much higher than its cost of capital, run by people who have integrity and understand capital allocation. Those are the companies that, if you can have a portfolio of those, and you have, in general, growing markets behind them, I think you're going to do pretty well over time.
You mentioned something there that I thought was very cool. When you're evaluating the people component of quality, you go above and beyond, it sounds like. You really dig deep into it, talking to people working at the company, really trying to put yourself in the best spot to get a feel for how the company's working internally and who's sort of leading this company. And I would almost consider that level of work, going above and beyond, almost an edge, right? It's that level of work that separates you maybe from other people. And that sort of leads me into a conversation I wanted to have with you about finding an edge. I think that is the toughest thing for anybody in the trading or investing world to really wrap their head around is everybody works hard, everybody's passionate. How do I know if what I'm doing is really distinguishing me from the next person? So I wanted to pick your brain a bit on that. Maybe starting with, from your own perspective, how do you know if you have an edge? And like, what sort of things do you think about when considering that?
Yeah, there's so much that goes into that. Maybe I'll start with the idea of edge as a whole. Um,
Great.
you know, I've evolved to think that it's very hard to develop an edge, and you're never gonna really know that you do, right? Like only the time will tell whether you did have an edge or not. So that's the first thing to
Mhm.
recognize, and there's a fair amount of humility that is required into it. Like you can do a lot of work, and you can perceive that you have an edge, and only time will tell you that. So that's one thing to think about. The other thing to think about is this great, Charlie Munger has this great quote is that you should fish where the fish are, and where if edge if there are certain fish for which you can have an edge and understanding, where do those fish live? And I would just say that those fish live in the smaller cap end of the spectrum, because there are fewer analysts, less sell side coverage, fewer hedge funds investing in these stocks. Like there's just fewer people looking at it, and so just by definition, I think you can have a, an analytical edge in a company that's 50 million market cap, way more so than you can have an Apple. Now, that
Yeah.
doesn't mean that you can't make money in Apple. I see large cap investing as really just like being a good contrarian. And that doesn't mean that you're like deep value or anything like that, but it's like the market thinks X, and I think it's X plus 10,
Mhm.
right, on the long side. And that's how people have done so well, like investing in these technology companies, is the market, whatever 10 years ago thought it was X, then it's actually 7X, right?
Yeah.
But I look at that as like you just have a contrarian thesis, hard to develop an edge. Like how many analysts cover Apple, how many different, people, write about it. Like it's very difficult, I think, to develop an edge, but you can, I think, in the lower market cap spectrum. Now, I don't want to overstate that though, because it's not, like there's still a bunch of information that you're never going to know. You're never going to be able to sit in that lunchroom and really understand the people, right? You're never going to, really have a sense of what their customers think unless you talk to hundreds or thousands of customers. And I think people read an expert network call with a customer and like, wow, this customer loves this company. You know, think about what the other side of that is though. Like maybe you reached out to 100 people and this was the only person who was willing to talk,
Mhm.
because the other 99 hate it and don't want to be on record saying that. Like it's, most people don't want to take an hour out of their day to crap all over one of their, with one of their partners, right? And
Yeah.
so you can't extrapolate a couple calls and say, well, this is the gospel. So where can investors develop an edge? I think the edge that you can develop, again, like for sure, you can, the smaller in smaller companies, I think you can know a lot more 2 or 3 years in than a person who's just approaching it. So I think on a
Yeah.
relative basis, you have an edge there. I think you can have an edge on people, right? Because if you've done the work and you understand the people, and other people aren't, and other investors aren't doing that, like we have an investment right now. It's one of our more controversial ones, which is Lumen, which is a former CenturyLink, and
Yeah.
our edge here, and this is a whatever, a 12 or $13 billion company. Um, we don't have an analytical edge in terms of understanding the company's markets and customers and competitive threats. What we do is we know the people. We were invested with the current CEO before he sold his company to CenturyLink, and we just think he's a value creator, and the market thinks he's not, and the market thinks he's a value destroyer. They don't think that he has an investing North Star, and we do. And because we have a history with him, and if you weren't invested in his previous company, you might not have that sense. And so we may end up being wrong, but I think we understand the people better than other people do. So, I do think you can develop an edge when it comes to people and capital allocation, right? Like you can, it's not unassailable, right? It's not like this huge moat. Other people can do the work, but I do think that if you understand people and their motivations and incentives, you can really, really do well. Because like if you think that someone's incentivized to sell the company and no one else thinks they are, and it happens, right, you're probably realizing value very quickly. So outside of that, where can you develop an edge? It's all in decision making, right? That's really, it's process, right? Like you have to have a good process, but that's just table stakes.
Yeah.
And then the way to distinguish yourself as an investment firm is through your decision making. And so again, getting back to what our process is designed to do, our process is designed to mitigate behavioral biases. It's designed to determine that, luck versus skill element. Are you just getting lucky, or is there true skill there? And it's designed to weed out companies that shouldn't be in our portfolio. So it's designed to screen through and hundreds of companies and only have a few fall out, because when you run concentrated portfolios, you only need a couple new ideas per year. And there's this, you should always have this filter, like, is this better than something we own, right? Like, let's pretend you have
Hmm.
zero cash, you have to sell something. What would you sell, right? Don't fall in love with just adding another idea, because, like, especially on a newer company, you don't have that intellectual history, and you may be the patsy at the poker table, right?
Yeah.
And so I think, and process is always evolving, and like how you're making decisions should always be getting better. But that's, at the end of the day, unless you have inside information, the only thing you really use, things you can control, are the quality of your process and the quality of decisions. And that's where we're focused.
Yeah. It's funny. That reminds me, it's like trading and investing is the one game where you can work really hard and still kind of lose. And that's that uncertainty factor that I think comes with not being with trying to understand if you have an edge. Time will tell. And do you think it's important for someone to really be clear on their expectations of their strategy they develop, and then moving forward, how do they really evaluate that? At what point should they say, like, I'm wrong here, versus am I going through a drawdown of my strategy? How can someone really be clear on that in this extreme or relatively extreme uncertainty?
Well, I mean, I think the answers to those things are slightly different depending on what you're doing. Are you
Mhm.
managing outside money, or are you managing your own money? But at the end of the day, it comes down to expectations. And so I think the really
Hmm.
important thing, and this is true for individual investors as well, is like, understand what your goal and mandate are, right? For us, we have clients that have a certain expectation, and their expectation is that we will, over time, not every year and not every quarter, but over time, be able to outperform the indexes, by which we are compared, right?
Okay.
And so that is our mandate, right? And our intellectually, does that, we want to be absolute return investors, we just want to make money, but you're compared to something. And so, I you can hate the idea that the entire investment world is benchmarked against these things, but it's the reality of it, and you have to understand your customers and your clients. And so, from our perspective, that's exactly what we're trying to do. We're trying to beat the benchmarks over time. And there are all kinds of flaws in the benchmarks. And when you own 25 stocks and you're compared to something that has thousands of stocks, you're never going to look like the benchmark, right? Like,
Mhm.
and in certain times that make you look really smart, and sometimes you look really silly. And that's what happens when you run concentrated portfolios and when you're a value investor, because there is a fair amount of contrarianism in that, like, you're going to be wrong for a while, because being a contrarian is hard, and often to be proven right, it takes years. And so you can look very silly for a period of time, and then look smart. And so for an individual investor, the way I would look at it is like, yeah, you should have expectations for yourself, and you should set them, and you should measure yourself against them, right? Just but always think about the base rate. What is the base rate of success for the US market? Is 6 to 7% a year, right? It's not compounding it 20 times, 20% every year. It's
Yeah.
not 50% every year. Those numbers are unsustainable if you are achieving them. And if you are achieving them, that's awesome. But you should think that maybe something's going on that's not sustainable, and reevaluate whether or not what you're doing is going to be, you're going to be able to sustain that. So, I think just not, we do way too much comparison in life and in
Hmm.
investing, and as comparing this company to that company, like everything is relative, right? And I
Yeah.
much prefer an absolute game. But even as an individual investor, have a sense of what you're trying to do, and like whatever. If you can't figure out what it is, do what Buffett did and try to beat the S&P, right? And that's your benchmark. And if you're consistently beating the S&P, and not taking insanely outside risks, that sounds like you're doing a pretty good job. But remember that base rate, right? The S&P's return like 6 or 7% over the long period.
So what do you think about this? I think that's a fair benchmark as well. Should you be using the long-term average return of 6 to 7% when comparing to the S&P, or should you be looking at maybe on like an annual basis, right? Because that 6 to 7% is not what happens every year, right? You have years that it goes down a bunch. You have years that goes up 20%. So if you're in a year where, let's say, it goes up 20% and you did 15%, should you still be comparing yourself to that long-term average? Or do you think it's more fair to compare yourself to the return of that year for your benchmark?
Well, I will say this, and some of this is a little bit self-serving because it's been very difficult to be a value investor in recent years.
Yeah, yeah.
And so, because there's a lot of things that we don't own that have done really well. But let me say a couple of things about that. All returns should be measured over a longer period of time. And I can't tell you how many years it takes for you to determine luck versus skill.
Mm-hmm.
Is it 3, 5, 7, 10, 12, 15? I don't know the answer to that. But I do think that in any year, especially if you run concentrated portfolios, you can look very smart or really very silly. And it's not necessarily an indication of skill versus luck.
Yeah.
So that's the first thing to remember, that in any given year, anything can happen. And so you shouldn't be too excited about beating the market in a year. And you also shouldn't be too downtrodden if you don't, because absolute returns still matter. And so if you're taking much less risk than the market, and you do 15 and the market did 20, if I told you for 2022 that you'd be up 15%, would that be good? I don't know, relative to 6 or 7%, that's pretty good. So
Yeah.
again, like, have a sense. So the answer to your question is both in a way. Like, if the long-term average is 6 or 7%, and that's kind of like your bogey for whether or not you're doing well over a long period of time, and sometimes it's negative 15, sometimes it's plus 20, but over a long period of time, you are able to beat both in the index that you've chosen and that 6 or 7%. I mean, I think that would be indicative of skill versus luck. And so, these things are the unanswerables,
Mm-hmm.
right? And so I think what you have to do is you just have to approach it with a long-term perspective, have some humility when things are going well, and, be easy on yourself and don't be too hard on yourself when things are going poorly, because inevitably this is a very difficult game, and you will look really smart and you will look really silly, and you have to be able to survive both of those periods of time.
Yeah, these are definitely difficult questions to answer because every strategy has variance, right? It's never going to be that perfect smooth line up and to the right that we'd all love to see in our accounts. But that's why I like to pick people's brains on this. It is difficult questions, and there is no clear answer for them. But I feel like these types of conversations help people at least really give it the consideration these questions deserve. I want to ask you about something else though right now. You mentioned in a podcast that valuations can go to unimaginable levels, and in the last year we've seen that in this meme stock era, we'll say, with things like AMC trading at like 20x sales, more. And what are your thoughts about these kind of stocks, right? Just in general, and this is so I'd love to get your opinion on, could a valuation model work for them in the long run?
I certainly don't want to talk about companies that I'm not, intimately familiar with, and I won't
Yes.
do that. But I can talk about this concept more broadly. A discounted cash flow model is still, the best way to evaluate a company. And certain companies lend really well to discounted cash flow models, and some don't. Like a bank, for example, you can't DCF a bank.
Mhm.
But let's say you're investing outside of financials, you should be able to justify the valuation of any company on some DCF basis. And so then that gets to two really important questions. What is the long term, what are the short term and long term growth rates? And then what discount rate are you using? And so the way I'd answer the question about the meme stock is, so if you're doing a qualitative investment, the qualitative research that we do and that we've talked about, like, digging into the competitors and talking to experts and looking at the end markets and doing all the work we do, what is the growth rate of a market, right? Why would this company be able to outperform that whatever the growth rate is for that market? And then plug that into a DCF and see what kind of discount rate you have to use to get the current stock price. And if you have to use a 2% discount rate to get the current stock price, I would say that stock is probably very richly valued.
Yeah.
And so again, it's like it's coming back to this idea that everything, you should think about base rates. What is the base rate of success in investing in businesses with secular challenges, which I don't think anyone would disagree that mall retailers and mostly what is the base rate of success in investing in companies that trade at high valuations with secular problems? I would just say that is very low. And so as you think about like how to approach a company like that, it's very simple for us. Like we don't go short, so we're not going to. That's not even in our thought process, and we're certainly not going to overpay for a business that has secular growth problems, that has potential business model disruption problems in the sense of AMC, right? Like the studios pulling things and doing them D2C. Like it's like it gets back to everything that we would already do. AMC and GameStop, nothing against those companies, but they would be thrown out of our process in 5 minutes, right? Because one, just getting to the question, is this a business getting more valuable every day? I would say the answer to both of those questions is probably for both of those companies is probably no, right? Okay, so if that's not the case, is it trading at a large discount to intrinsic value, and we have some value catalyst that can get us get it closer to fair value? Well, if it's trading at 20 times sales, I mean, there's a lot of much better companies you can buy for 20 times sales, and I don't know if those are going to make any money, right? And so, taking a step back, we're not macro investors, and I don't want to spend too much time on it, but there's an amazing amount of liquidity sloshing around, whether it's from stimulus dollars, whether it's from whatever, people are taking second mortgages on their houses, investing in meme stocks. Like there's just a lot of money flowing around. Interest rates are low. Just about any activity can be financed at very low rates right now. And so what you see in times like those, and like these, is that asset values will go to levels that you never expected, and that are probably unsustainable. And so as an investor, what do you do with those things? I just don't think, if your first two rules about investing are not losing money, you just don't play that game. What's the point, right? Do you have an edge there? Is there, so there's this greater fool theory of investing, where you buy something hoping that someone will pay a higher price.
Yeah.
That's a good way to end up, not having any money.
Yes.
So why even play the game? There are thousands of public companies out there that you can invest in. Why even? Because to some degree, you have to admit that you're speculating on certain companies that trade at really high valuations, especially if they have secular problems. And so play somewhere else. Fish in a place where people are not looking, misunderstanding, and where you could potentially have an analytical edge.
I think that's great. And that is almost good business philosophy too, in a sense, similar to the North Star sort of philosophy, where understand your process and what you're trying to do. And along the way to accomplishing that goal, there's going to be a whole bunch of shiny objects along the way. Don't get distracted. Right? If it
100%.
doesn't fit your strategy and your ideas, then it should be discarded quickly. Right?
One of the things,
What do you think?
one of the things I tell young investors is that to be good at this and to stay sane, you have to be 100% comfortable that you will miss hundreds and hundreds of things in your career. There will be things that like you looked at very carefully and you passed on it for a number of good reasons and it goes up 10x. Yeah, and it sucks, but your clients never know about that, right? If you make an error of omission, clients are never going to know about it, right? Now, eventually, if you continue to do that, it'll show up in your returns. But you can't. You have to be okay with the idea that things will happen that you don't expect, and things that you don't think will do well, and you have to wake up the next morning and look for the next opportunity or be excited about what you own. And so that gets down to like, don't don't lament on things that you've missed. Learn from mistakes, learn from errors that you made in decisions, learn about business models that maybe you didn't understand before, and now you can apply what you've learned to the next company. But don't waste your time thinking like, oh my God, I looked at this at $5 and now it's 40. Like what, like what is that going to do, right? That doesn't make you a better investor, and it's probably just going to drive you crazy, right? And then when that happens, all kinds of behavioral biases start kicking
Yeah.
in, and so just be okay with the fact that there will be stocks that you are wrong on, and they will go up a lot, and you just move on to the next one.
I think that's really good advice because I can really empathize with the retail investor and trader who works really hard and their plan is going all right. And they look to their friend to the right who just made a 50x return buying an out of money call on GameStop. And you're like, really? I'm doing all this? And it can definitely create almost like that FOMO, which definitely leads into all these biases that can really mess up your system. So I think that's phenomenal advice. A lot of our listeners have a goal of breaking into the industry. And just like trading is itself, getting into it as a professional career is also very competitive. And I've looked into your story and I actually found it quite fascinating. And I thought it'd be cool to have you share about how you got into Cove Street and your journey to professional investment management as a way to maybe give others some ideas of how they can begin to build a name for themselves in the space.
Yeah, I mean, I think the most instructive example or anecdote that I can give is how I ended up at Cove Street. So I'll briefly go through the story because it's not, no need to go too deep in it.
Yeah.
So I was in business school in 2009, and I was very keenly aware that given the state of the world, even when I graduated, who knows what the job market for investment management was going to be. It was very murky at that point. And so, I had decided that in order to stay in the game and keep my name out there, my idea was to start an investment blog. Um, Similar to a decision I made just to start a new podcast. I thought that it was a way to, expand my own personal brand and to, just meet new people, have your name out there, so that when I was looking for a job, like I'd be top of mind. And so, just like with this podcast, I'm really focused on having some kind of content that is differentiated, exclusive at best, but just differentiated content, something that someone else isn't doing. And so back in the kind of 2009 2010 period, the Berkshire meetings weren't transcribed and they weren't live streamed. And so to hear what Buffett and Munger said, like you either had to be there or you had to read someone's notes. And so it was, I think the first year was 2009. I made the decision to try to take notes from the Berkshire meeting. And so for anyone who's ever been there or watched it, it's really, really long. I think it's almost 6 hours in terms of like the everything. And so
Oh my
you
God.
you end up with a lot of notes. And so I'd spend like 5 or 6 hours taking notes and then like 10 hours or more editing them because it just takes so long to edit all of those words. And I launched the blog with the notes from the meeting, and that was like, it was someone that like there were whatever 20, 30,000 people who go to the meeting every year, and there were probably just a handful of what would you think of as like comprehensive notes, like as opposed to just like bullet points, and like these were like
Hmm.
question, what did they say, like in a format that was like, you not like you were being like you were there, but something close to that. But and
Yeah.
so, so the story there is that I'd started the blog, and I was looking for a job in 2011, and I got an email from a guy saying, "Hey, I heard about your blog. I'm starting a firm. Let's talk." And it turns out that was Jeff, who's our founder, and a guy who I didn't even know who followed my blog knew Jeff and said, "Hey, you got to meet this guy. Like
You're kidding.
anybody who's crazy enough to sit there and take notes for 6 hours, you have to talk to." And so Jeff, in all honesty, had decided to hire somebody else until he met me. And so some luck, some skill, I was able to get my position at Cove Street. And so what I say to people about that experience is not that it's replicable. I mean, that just seems that, yeah. Who's starting a blog these days to try to maybe a Substack? Maybe it's a Substack now, but
Yeah.
starting a blog these days to get a job. But really, what it is you need to distinguish yourself as your own personal brand, as an investor, as a thinker, and I think you have to be willing to do something a little nutty. And if you do things that are a little nutty, if you're willing to work harder than other people, I think you put yourself in position to get lucky. And so that's the story there, is that you be willing, and I tell young investors all the time, figure out where you think what you are specifically good at, even if you're not coming from an investing background, even if it's real estate, even if it's marketing. Find something that you are good at, a company that you can be just absolute nails on because you're in this industry, right? Just find your edge in whatever you can do, and then be willing to work harder and do something a little silly. um, that's the best way to break in, unless you were just like handed an opportunity because you went to the right school and you had the right family last name. Like, I think that's the best way to do it.
That's really cool. And you see some people doing that now with podcasts and Twitter and everything like that. So let me ask you this. In terms of all the media and information that's out there now for investors, is there something that you see missing in that space that you've kind of gone, oh, it'd be cool if someone did this or anything like that? A little bone you can throw to some of the listeners who are maybe saying, yeah, that's a good idea.
Well, I mean, not to talk against myself, but I'm a value investor, so I have to do that. I mean, starting a podcast is now a very difficult thing to do, to get mind share and get people basically take part of people's time wallets,
Hmm.
right? Because how many podcasts are out there? So aside from the fact that I have just done that, I feel like I have a slightly different platform than someone, being at being having relationships with public companies and stuff like that. So I don't
Yeah.
know if that's the answer, but I am a fan of writing down your ideas and doing research. And so whether that's doing Twitter threads, whether that's creating a Substack account and writing ideas, like that is a way, and being on Value Investing Club, whatever you can do to show the depth of your research and the quality of your ideas, that is a way to distinguish yourself. It still works. If if you you know it may be hard to get an investment manager to read one of your ideas, but if you do and it's good, like, and they're hiring, they're going to interview you, right?
Hmm.
Like, and so I always tell people one thing: don't go into an interview and pitch a company in their portfolio. Good luck with that, because they're going to crush you on it. And secondly, don't pitch a large cap stock that everyone has an opinion on. Pitch some 50 million micro cap company that no one's ever heard of, that you can actually have an understanding of. And look, and if it's a large cap strategy that you're walking into an interview for, pick something that is not Apple, Microsoft, Facebook.
Yeah.
Find something that is possible, that they may appreciate the work and your opinions on it, because you're not going to have an edge in those bigger companies. And so again, it's like, fishing where the fish are, using whatever skill set you have to find a company that you have a unique ability, or a good ability to analyze. I think those are the two things that can really work, and just avoiding getting into conversations with people who know a lot more than you do.
It's so funny how it's even outside of just the investments you choose to make and the strategies you choose to implement, but it's really almost a worldview uh, of like trying to think about having an edge and thinking about the world in that way that I see as a commonality amongst successful investors and traders. It's just something that I find so fascinating. Even when you're applying for the job, it's like, do something to differentiate yourself. Find a way to have an edge over the other guy applying for the job. If you know everyone else is doing Apple, Microsoft, Facebook, do something different. Give yourself that shot at standing out. So I just find that quite fascinating.
Be a contrarian, right? To be a good investor to some degree, you have to be able to not completely stand against the crowd, because sometimes that can be, being contrarian for the sake of a contrarian is a good way to lose a lot of money.
Yeah.
But to stand apart from the crowd, maybe swimming in the same direction, but just like, slightly to the left. And so I think everything you do, think of yourself as a brand, right? And how do you distinguish your brand is you need something unique, you need something differentiated, you need something that, like, when you walk out of an interview, they remember, like, this is who you were, this was your brand, and this is how it's different than other people, right? Like, so you're right that it permeates everything I think about. It's not even just a business thing. Like, everything you should do, whether you're having a conversation with someone, like, try to provide some unique insight, try to take the other side, try to be a contrarian, try to take the bear case. Like, that kind of thinking allows you to put yourself in a position to have differentiated thoughts. And there's a simple rule about investing, or probably trading as well, is like, how do you make money? You have to be thinking something that the market isn't thinking, right? That's not already embedded in the stock. And so that mindset, I think, is really beneficial.
Yeah, it's the area where you disagree with the market is the opportunity, right? I think that what do you think about this? All the learning that you do, and reading different things, exploring different industries, is almost building yourself into the person who can be a bit more of a contrarian, but not for the sake of it. As you mentioned, it's not for the sake of being it, but it's almost for the sake of having your own ideas, right? And really developing your view on things. And it's the reason it's not doing it for the sake of doing it is because it's actually genuinely where you have that disagreement, and then having the confidence to express it, I suppose.
You're never going to get any clients if you don't have opinions, and if you don't have, whatever, they have to be backed by research and whatever, good decision making. But this is a business by definition. I am buying a stock, I am selling a stock, I have an opinion that is different from what the market is saying. And so whether you're consider yourself a contrarian or not, you have to understand what you're thinking relative to what the market is thinking. And then you have to hopefully have some kind of reason to believe that you are right and the market is wrong. And you have to approach that with a fair amount of humility, because that means that you are betting against the common perception of millions of other people.
Mm-hmm.
And so, there's a certain blend of arrogance and humility that is required in investing, which is what makes it so hard. You have to simultaneously have a huge amount of conviction in something that the market is telling you you're wrong in, and also have the humility to admit very quickly when you're wrong, so that you don't lose money. This is why I talk so much about managing your own emotions and managing your own behaviors and understanding your own biases, because it really is the only way to be successful for the long run. And even successful traders and investors who maybe don't articulate it that way, they have found some formula to do that. They just may not call it exactly what I'm calling it. They do it in their head, and they don't necessarily say, I'm mitigating biases or I have a process. But they have found a formula that allows you to overcome your weaknesses, which everyone has.
That was very well said. I think it's so important to have that sense of self-awareness. And there is that sort of duality that makes a good investor, right? The arrogance or confidence that to go against the crowd and be like, I am betting on my idea against the market. But then also you need to know when you're wrong. You need to be able to say I'm wrong and cut that position. And I think that's actually something a lot of traders struggle with. is not so much the having a belief in an idea. I think a lot of people have that, but it's the humility side of knowing when you're wrong and being able to actually embrace a loss as a part of the game and take the loss. Uh, it's a hard thing to do, but I think that's actually one of the things that really separates the successful from unsuccessful investors in this game.
If you understand the odds, and that you know, some if you bat, no one bats 1,000. Anyone who bats under 500 is probably out of the game, right? And so that leaves a band of people who are above 500, and whatever
Yeah.
gets 50 to 60% of their stuff right. If you understand that, you approach everything with a fair amount of humility, knowing that there's probably just like a slightly better than 50% chance that you're wrong, right? And so if you think about a stock as a piece of paper that you trade, and it's just a ticker on a screen, versus a business that you invested in, run by people, that you can actually do a lot of work on and still be wrong, right? Like it just really puts into focus how hard this is, and how important it is to have processes and decision making methodologies that are consistent.
So let's end off this podcast with a real world story from you about either a best trade or a worst trade from your career and what you actually learned from that experience.
Yeah, I mean, I'm someone who suffers from a fair amount of loss aversion, and so I feel losses much more strongly than gains. And so,
Ooh.
when we were talking offline, and you were asking me about my best investments, like those were harder to come by in my
Yeah.
mind. And I think, listen, you can learn a lot from good investors and their investments for sure. Like their whatever, someone who bought Amazon in 2004 or something like that, and is whatever extraordinarily wealthy now, right?
Mm-hmm.
Like you can learn a lot from those people, but I personally learned more from my mistakes. So I'll briefly go over an example, and it really, we're going to come full circle here, where we started, which is about investing in businesses that could take a punch. And so we invested in an apparel licensing company. So like this company basically was licensing its brands to large retailers to sell the physical clothes in their stores. And this company had high margins, good return on invested capital, had a great capital allocation, but always had that binary risk that there was one large retailer that was over 20% of their revenue.
Hmm.
And that relationship was like 25 years old. And so you assume that there was some stability there. But this company had a change in management, and they decided to, instead of licensing other people's brand, to do it in house. And so they kicked this company out basically. And that set off a series of events where this company used leverage to quote unquote make up for the customer loss. The events that followed, you notice I'm not naming the company because
Yeah.
it's not really that important, but the events that followed led this company to basically go bankrupt.
Oh man.
Um, and so this was a good business. It looked like it was getting more valuable every day. They were diversifying their revenue base away um, from this one customer. They had a CEO who talked the capital allocation game. He actually used to hand out books of Thorndike's Outsiders to people because he loved it so much. So all of those things in place, but yet in order to replace the lost customer, they made a levered deal that they literally could not handle because it
Hmm.
was so complex, and that toll that it took on the people, and there's some issues with the company they bought, basically made the company go bankrupt. And so to me, that investment stings in so many ways, but really the big lessons are: invest in a business that can take a punch, avoid companies that have binary risks of some kind where one event can throw the company off its trajectory, do a lot of diligence on people, and make sure that they actually have a true North Star and are not just like feigning having a North Star. I mean, I think those are three lessons that I will never forget. And I literally, like, it might as well be just imprinted on my arm as I look at new companies.
I was going to ask if you got them tattooed yet.
It should be. So an event like that, even though it was like it wasn't even that much, it wasn't like whatever, it was 15% position. It was a smaller position of ours. Like, but just watching the process and seeing how it went all wrong, you're never going to forget that. And you don't want to overlearn lessons. You don't want to learn the wrong lessons. But I don't think the three that I mentioned are not applicable. I think they are applicable across like any investment you make.
100%. It's lessons like that also course correct your trajectory as a trader for the better. You just hope it's not too big of a loss that it takes you out of the game. So I'm happy to hear it wasn't.
Yeah.
But Ben, thank you so much for coming on the podcast. This was extremely, extremely insightful. Regardless of what sort of view on the market I think our listeners take individually, so much value from what you just shared. I know that you've got a podcast out now. If you wanted to talk about that briefly, I'm going to link that down below. And if there's anything else you wanted to share with our listeners.
Yeah, Sean, thanks so much for having me. I mean, I really enjoyed your questions. I thought they were great questions. I know maybe we have a slightly different strategy than maybe some of your listeners, but that doesn't mean that it can't be instructive. I think you should always be looking to learn from people. And that's why, getting on the podcast topic, I listen to all kinds of podcasts, right? Some about investing, some about politics, some about
Yeah.
economics. I love like being an information. I just love information. That let me give a very brief overview of our podcast. It's called Compounders: The Anatomy of a Multibagger. And what we're doing is we're allowing listeners to be a fly on the wall for the actual conversations that we have with public company management teams. And so I interview public company management teams. I ask them the same questions I asked during the Cove Street's diligence process. And the idea is to get a holistic understanding of how companies have compounded capital over a long period of time. So our first three interviews are out. The first two interviewees were Fortune 500 CEOs, which I think was a pretty good start. I think the content is a little different because there just aren't that many investor-led conversations with public companies. Like, yeah, you'll see like Variety interviewing, media CEOs and stuff like that. Nothing against the journalists, but like they just have a different lens. And then there are plenty of podcasts of investors interviewing other investors, but investor-led conversations with public company CEOs that really are focused on like how do you build a company, and that's not just capital allocation. It's culture, it's hiring, it's retention, it's strategy. It's like all of the above. What are all of those dots on that painting that create a good company? So look for us on Apple or Apple iTunes or Spotify. It's called Compounders. If you search that, you'll see us. You can also follow me at Twitter at Ben Claremon if you want to get updates about what we're up to.
Brilliant. Thanks so much for coming on, Ben.
Sean, thank you. Really nice to be here.